glad you asked. So artificial intelligence is the ability of a machine to think and learn like a human. So what's different today versus that of the past? In the past, computer systems were being programmed by humans. So they're being told specifically how to arrive at an answer. They're giving it strict rules and parameters. What's different today is that computer systems are being trained or taught, and that teaching process is by feeding it data. And data is similar to how you and I have grown up as from reading books and experiencing life. So that's data, and the data is what's making the computer system to be smarter and smarter. Over time, the system itself will continue to gain more intelligence as it gets more experience through absorbing data. So the artificial intelligence is the ability of a computer system to have its own logic, and therefore it can process information and predict or derive and make decisions. In the coming years, artificial intelligence is going to have tremendous impact across a lot of different industries. It will impact the technology sector for sure. A lot of companies there will have to transform as they offer other products and services to cater to the demand. But end industries that use the technology to differentiate themselves, companies in financial services, companies in agriculture, company in automotive, company in healthcare, consumer products, they will use the technology to differentiate themselves from the perspective of either streamlining their business processes to improve their cost structure, or develop new products and services to engage the market and have a new sales channel. So it's going to be very transformative in the coming years. The opportunities for investors is from various segments. One is technology enablers. These are the traditional technology companies, also a new class of technology companies that will eventually come public. But today, it's mostly the technology companies that are enabling AI for either Google or Facebook or Apple or big companies in general, banks like JP Morgan and others. But over the longer period of time, as the technology become more broadly deployed across all these different industries, you're going to find opportunities outside of technology, meaning that companies that used AI to differentiate themselves, those will be interesting investment opportunities. So we look at the investment opportunity from a variety of segments, one from a technology enablement, and also the end AI-enabled industries that benefit from the use of AI and as they continue to transform themselves. Yeah, we get that question asked. So when you look at the technology sector, S&P 500 tech versus S&P 500, the PE multiple of both indices are essentially similar, not much difference. When you compare that to the year 2000, the S&P 500 tech indices versus that S&P 500 was a very big range in terms of valuation. The tech companies at that point in time sometimes were trading as high as 50 to 60 times PE, whereas the underlying market was about, at that time, 16, 17 times. Today, S&P is around 17 times. The tech is about 17 times. So they're about the same. But in any given 1 year, you're going to have subsegments within technology that see big multiple expansion. That's simply because they're going through a very strong growth phase. Investor wants exposure to those growth. But the overall aggregate in terms of the technology sector, the valuation is not as extreme, nowhere near as extreme as it was in the prior years. And from a bubble perspective, bubble is usually created from excessive investments, speculative investments, like we experienced in the 2000 era, or like the real estate crisis of 2008. And today, when we look at what's happening in AI, where companies are investing in AI, they're getting a return on investment. So there isn't any speculative activity going on where companies are investing and they get no return from their activities. There are always good investments outside of the U.S. And the reason why we're 86% in U.S. today is our portfolio structure where most of our exposure are in the technology sector, because they benefit initially from all the different activity that's going on in AI. And most of that activity just happens to be US dominated. That's not to say great companies out in Europe, such as Infineon, STMicro, or ASML, or so forth, or SAP, that they're not benefiting. They are. But when we look at their growth profile relative to that of the US companies, the US company have similar, if not greater growth compared to the European counterparts. And we're not paying as much high of a valuation when compared to the European counterparts. So we believe the stocks that we have in the portfolio gives us better growth and at a more reasonable price. But as other opportunities unfold in the coming years, we'll go where the earnings growth are. Yeah, that's a very interesting question, because today, when you try to screen for 100% AI, there's actually really no such thing. From a technology solutions provider perspective, all the hardware and software companies, they all have businesses from the prior generation, but they have new products and capabilities to enable customers to adopt AI. So it's transformative. It's transforming their business as they have more sales related to AI. It would be nice if we could find 100% pure AI companies, but to this day, from a listed securities perspective, it's almost non-existent. So we have to look for companies that are transforming. Either they have a unique product that can grow from a small percentage to something larger, and hence that accrues to their overall financial performance and how their profits and earnings will grow. So it's one that we monitor from the perspective of how is that company progressing over time. It's going to take many years before some of these existing companies, to get to a meaningful percent that's AI. But along that path, that transformation will drive their stock because of better profits and earnings.
Thank you very much.
Okay.